I'm sorry guys, but this video is not going to be enjoyable. It hurts me to do it, but I'm going to tell you the cold hard truths as to why you're getting less returns than you actually think. Believe it or not, it all comes down to some simple maths that most investors overlook. But don't worry, it's not really all doom and gloom. We're not just going to tell you why you get less returns, we're going to tell you what you should do with this information. So, in a sense, I'm punching you in the face with a fistful of reality, but at least I'm giving you a plaster to seal the wound afterwards. On that note, let's not waste any more time. Let's get into it. The stock market. A white knuckle ride that we all endure to help us grow our assets. Some weeks it's up and some weeks it's down. Nobody knows where it's going to go. Sometimes it's good, yet sometimes it's bad. Really bad. But don't worry, whenever we get a market crash or a fall in prices, we tend to get a bounce back or some sort of correction. Surely that can't be a bad thing. A 50% fall in prices followed by a 50% rise in prices. That's a good thing, right? Wrong. And I'm going to tell you exactly why. The returns that we receive as investors are relative. In 1920, the Dow Jones Industrial Average had an average closing price of 90. Back then, if it was to gain 9 points in value, that would be a 10% increase. If the Dow increased by 9 points today, that would just be a 0.03% increase in value. So, the percentage return that you receive is dependent on the point at which you started at. This can be seen a bit more clearly in the relative change equation, where C, the relative change, is equal to F minus I divided by I, where F is the final value and I is the initial value. You can multiply this by 100% to get a percentage change. The larger the initial value, the smaller the percentage change. But don't worry, I get that this is a bit confusing and you're probably wondering why the hell does this even matter? Well, I'll show you why this hurts your returns in this little example. Let's say that you start with an investment of £1,000. In year 1, the investment grows by 100%. But then in year 2, it falls in price by 50%. So, if we were to look at the average yearly return, it would be 100 minus 50 divided by 2. That's 25%. So, an average return of 25% per year. That's great. But in real terms, that's not the actual returns that you'd experience as the investor. To explain what I mean, let's plug in some numbers. You start with £1,000. After year 1, you get a 100% increase, which takes the total value to £2,000. Then, in year 2, you get a 50% decrease, which takes you back down to £1,000. So, over the 2 years, you have a total return of, well, 0%. Now obviously, this is much less than the average of 25% per year that we just showed. But why is this happening? Well, if we link this back to percentage or relative change, when you increase in price, you're going from a small number to a large one. And when you decrease in price, you're going from a large number to a smaller one. So what can we take away from this? Unfortunately, percentage decreases are much more significant than percentage increases. Don't worry, it's not always as intense as the example that I just showed. Let's say that you start with £1,000 and you get a 10% increase in year 1, followed by a 10% decrease in year 2. You go from £1,000 up to £1,100 and then back down to £990. This is a net loss of £10, or 1%. It's not bad, but it's certainly not great. This just shows that the numbers, or average returns that you usually see, are often misrepresentative of what's actually happening. To help put this into a bit more context, let's apply this to a real world example. Last year, when the markets crashed at the beginning of the pandemic, the S&P 500 fell in value by around 32%. Now, it's easy to think that the markets would just need to increase by 32% to get back to square one. But from what we've just showed, we know that this is not the case. It works out that after a 32% fall in prices, we then need the prices to increase by 47% to get back to where we once were. So, I'm sure you get the point now, and quite frankly, I'm sorry if I had to break it to you. The falls in prices are much more intense than the rises in prices. But before we tell you what you should do to combat this, we'll go over one more reason as to why your returns might actually be less than you originally think. This one is the arch nemesis of investment growth, and I'm sure you all know what it is. Inflation. Inflation is quite simply the decline of the purchasing power of a currency over a given period of time. As time goes by, the price levels of goods and services often rises, which means that your money, in a sense, becomes less valuable. Inflation slowly creeps up over time. Over a short period of time, you're probably not going to notice it, but over a lifetime, it's hard to ignore. It is quite frankly an investment killer. We invest to make money and to grow our assets. But what good is that if the prices of goods and services in our economy grows faster than our investments? Well, luckily, that's rarely the case. But either way, the inflation growth should be subtracted from your investment returns to give a more accurate representation of how your money is actually doing. Here's some data on the yearly inflation rates in the UK from 1960 through to 2019. In the 70s and 80s, there were some crazy figures, with inflation rising as high as 24% in 1975. The thing that makes inflation so scary is that it is money that you are never going to get back. In investing, yes, you get market crashes, but there is always growth to be had in the future, and the markets have always recovered. But when it comes to inflation, that money is essentially gone. The purchasing power of your money has decreased, and it's not going to come back. And whilst you sit there worrying about how much money you lost last year because of it, inflation doesn't sleep. It just keeps going and going, eating away at your purchasing power. For the UK, the average inflation rate from 1960 is 5.13% per year, but the average over the past 20 years has been much lower, at just 2%. Still, it has to be accounted for, and if your money isn't outgrowing inflation, then you're losing out. This is why investing is so important. If you were to just leave your money in a bank or under your bed, then over a lifetime, you're going to lose out massively. So I get it. This all sounds really negative, but what can we actually do about it all? Well, the key is to actually make yourself conscious of the fact that historical market returns are often misleading. We need to take into account the lower returns that we're actually going to get when the returns are annualized and adjusted for inflation. This way, we can strengthen our financial planning and make better financial decisions in the future. To show you what I mean, let's look at the data, which I got from moneychimp.com. They have the returns of the S&P 500 index, ranging from 1871 to the end of 2020. If we set this time range to be from 1920 to 2020, that is 100 years, we can see that the average yearly return is 12.32%, which sounds great. But first of all, this is ignoring inflation. When we adjust for that, the average return becomes 9.53%. Now, this is a value that you tend to hear get thrown around a lot, as the historical return of the stock market. I think I've even done it on this channel before. Since 1926, stocks have returned around 9 to 10% each year. Shut up, you idiot. As we mentioned before, this is not the real return that an investor would actually experience over this time frame. The value we're looking for is the compound annual growth rate, or annualized return. This is the actual average return that an investor would receive. For this example, it works out to be 7.63%. So we've gone from an average yearly return of 12.32%, adjusted for inflation to give 9.53%, and then annualized to give 7.63%. So whenever you hear that the stock market returns 10% each year, and that's the growth that you should expect, it's wrong. I mean, yeah, in a sense it's right, but really, it's wrong. As investors, we need to set realistic expectations of how much our money is going to grow by. So then we can set realistic expectations for reaching our financial goals. If you're expecting to get 10% each year from the stock market, then you're probably going to be confused or upset when you don't actually get that. Let's say that an investor invested in the S&P 500 from 1980 through to 2020. In this example, we'll adjust for inflation. The average yearly return for this time period was a tasty 9.99%, whilst the annualized return was actually 8.72%, which is still respectable. Now, let's run some actual numbers, using a compound interest calculator at thecalculatorsite.com. Let's say that starting from scratch, you expect to get returns of 9.99% per year because that's what the average says. You're going to invest over 40 years, with your money compounding each year, whilst depositing £250 per month. At the end of it all, congratulations, you end up with around 1.4 million. Easy game. But as we showed, the actual annualized returns would be 8.72%. When we put that into the calculator, you end up with just under 1 million. Now, don't get me wrong, I'm not complaining with either result, but the difference is still huge. Between the two scenarios, there is a difference of £400,000, which simply cannot be ignored. In percentage terms, you actually end up with 30% less than you expected. So why does this matter? Because that is a lot of money. If you're making financial plans based on returns expectations that are inaccurate, you're likely going to fail. By setting realistic returns expectations, you're more likely to reach your financial goals that you set. This, of course, is going to make you happier and give you a sense of fulfillment in your life. If you were to set some financial goals that are, quite frankly, unachievable, then you're going to be bitterly disappointed when you don't actually achieve them. All down to some simple maths. As far back as we have the data, the S&P 500 has returned an inflation-adjusted annualized return of around 7%. Not 10%, not 9%, 7%. We should not expect this to be any higher. As we mentioned in our VUSA video, the markets have become expensive. This can be seen in the rising PE ratios. This rise in valuations has partly contributed to the higher returns that we have realised. We are currently paying a relatively high price for assets, so the future expected returns are generally lower. So don't be surprised if we actually get future real returns somewhere closer to 6%. I know, it sounds horrible, doesn't it? Ultimately though, this is all speculation, and only the future will tell what returns we actually get. But the moral of the story is to not expect anything above 7%, because based on the historical data, that would be overachieving. We should be happy with what we're going to get. And with that, thanks for watching everybody. I'll see you next time.